Hello, this video will explain 3 things you need to know about Japanese transfer pricing audits. Japanese transfer pricing audits can be some of the most difficult and time-consuming tax audits that you will ever experience. The Japanese Tax Authority has issued a number of large transfer pricing assessments and continues to audit a variety of taxpayers, both foreign affiliated and Japanese headquartered companies, and companies in a wide range of industries. In most years, there are between 150 and 240 transfer pricing adjustments as a result of tax audits. Compared to 12 or 15 years ago, the total annual monetary amount of TP assessments has declined, but the number of cases has increased substantially. This suggests that the Japanese Tax Authority is no longer focusing on just the largest transactions and taxpayers, but also on smaller cases. In other words, taxpayers who were relatively safe from scrutiny in the past are now at higher risk. In this video, I'll present a case study which illustrates 3 important features of Japanese transfer pricing audits that make them particularly difficult. Acme Japan is a subsidiary of Acme Corporation, a US-based multinational that manufactures and sells widgets. Acme Japan has only one tax manager. We'll call her Sato-san, responsible for all Japanese tax issues, including responding to tax authority audits. In 2021, Acme Japan becomes the subject of a transfer pricing audit covering its purchases of widgets from Acme US for resale in Japan. And now we come to the first feature of Japanese transfer pricing audits covered by this video. They are extremely detailed and time-consuming. In a worst case, they can last for 2 or 3 years at a pace of 1 to 4 meetings with the examiners per month. In Acme's case, in the first 2 meetings with the examiners, Sato-san receives questionnaires which contain almost 50 questions, and over the course of the audit, additional questionnaires are issued almost every month. By the end of the audit, hundreds of questions have been issued. The requests include requests for interviews with certain department heads so that the examiners can understand the functions and risks of Acme Japan. Sato-san now has to coordinate with multiple department heads to arrange interviews with the examiners to help them understand the business. All throughout this process, Sato-san has to report the audit status regularly to the tax director at Acme headquarters and have numerous conversations with her tax advisors about the best way to respond to audit questions. This, of course, places a significant strain on the resources of Acme's tax and finance teams. As Sato-san is doing this in addition to all her other job responsibilities, she finds herself doing more and more overtime. Among the questions from the examiners are requests for information held overseas, specifically information on Acme headquarters and other Acme entities involved in the supply chain, including financial statements, P&Ls segmented for the overseas affiliates' transactions with Japan, organization charts, headcount, and other information. Some of the requested items seem irrelevant to the transfer pricing for Acme Japan. Some are highly confidential. Others, such as segmented P&Ls of the overseas affiliates, are simply not available. Sato-san spends hours discussing with Acme headquarters and her tax advisors whether to try to create such information or to decline and risk the imposition of presumptive taxation, which we'll discuss in a moment. We now come to the second important feature of Japanese transfer pricing audits, the annual personnel rotations at the Japanese Tax Authority. Every year in July, a large proportion of Japanese tax officials rotate to different positions within the tax authority, which causes changes in the examination teams. In the case of Acme, after a full year of audit activity, all of the examiners on the audit rotate, and an entirely new team takes over. This delays the audit even further as the new team has to catch up on all the discussions of the past year. Since some of the discussions centered on the functional profile of Acme Japan, the new auditors decide to conduct a new round of interviews of certain department heads in order to verify the company's functions again. Sato-san now has to spend time coordinating a whole new series of interviews with various department heads. And now we come to the third important feature of Japanese transfer pricing audits, the possibility of presumptive taxation. Presumptive taxation is a risk that looms over any taxpayer subject to a transfer pricing audit. It is something that the examiners can do when the taxpayer has not sufficiently responded to their question in a timely manner. Specifically, if the taxpayer does not submit their transfer pricing local file documentation by the deadline set by the examiner, which can be a maximum of 45 days or 60 days depending on whether the contemporaneous rule applies, or if they do not submit other requested information by the examiner's deadline, which can be up to 60 days. In these circumstances, the examiners are authorized to conduct their own transfer pricing analysis, which could potentially be based on secret comparables. In other words, the examiners can visit third-party companies and collect data on profit margins of those companies' business segments or transactions, data that are not publicly available. They can then use this profit margin data as comparable transactions and calculate a TP assessment. In recent years, the Japanese tax authority has refrained from using secret comparables in most cases, but in Acme Japan's case, they become so frustrated by the company's unwillingness to provide some of the requested data that they announce their intention to use presumptive taxation. They explain that they have found a secret comparable transaction with a gross profit margin of 51%, which is higher than Acme Japan's gross margin of 40%. Based on this comparison, the examiners announced a tentative position calling for an 11 billion yen, or approximately 100 million US dollar income assessment. By this point, 2 years have passed since the start of the audit. Following this, the tax authority undergoes another personnel rotation, and some of the examiners change again. This generates additional duplicative meetings, interviews, questions, and other discussions. Sato-san, now suffering from long-term sleep deprivation and related health problems, spends the next 6 months responding to the examiner's position and, together with her tax advisors, arguing with the examiners over the validity and the fairness of secret comparables, which Acme cannot verify or analyze. After another 6 months of interviews, arguments, and settlement negotiations that ultimately fail, the tax authority issues a formal assessment which results in additional taxes and penalties of approximately 40 million US dollars. Overall, the audit has lasted for 3 years. Sato-san, exhausted from dealing with the audit, quits her job and takes 6 months off to recover before joining a different company. Acme Japan hires another tax manager to handle the ongoing efforts to relieve the double taxation resulting from the TP assessment, which include a mutual agreement procedure as well as domestic appeals. These efforts require another 2 years to resolve the case. Now that we've examined the 3 features that make Japanese TP audits particularly difficult, let's consider what the taxpayer can do to make them less painful. First, and most obviously, it is critically important to be prepared. Taxpayers who have robust documentation ready at the start of the audit are in a better position to explain their transfer pricing and to influence the course of the audit in a favorable direction. This also helps the audit to proceed more quickly. Second, at most companies, it's important to get your regional and global tax teams involved from an early stage. In other words, the local Japanese tax or accounting team should not be left to fend for themselves. The regional or global teams may have experience dealing with TP audits in other countries and may be able to share insights with your local Japan team on how to handle questions from the examiners. Also, in this era of increasing transparency and information exchange among tax authorities, your regional and global tax teams will want to be aware of any information shared with the Japanese tax authority and will want to ensure that that information is consistent with information provided to tax authorities elsewhere. Third, it's important to know how to respond to tax authority questions and how and when to push back. For example, In many cases, the requests include requests for information that does not exist or that would have to be newly created. In such cases, it's possible to negotiate to narrow the scope of the requests or even to decline certain requests. It's also possible to negotiate over the language of the submitted documents. For example, where the examiners have requested your transfer pricing documentation in Japanese, but it's only available in English, you may be able to negotiate to provide the English report as is, or to prepare a Japanese summary without translating the entire report. Of course, whenever you push back against tax authority requests, it's necessary to be careful not to be regarded as uncooperative, because there is the risk of presumptive taxation mentioned earlier. However, it is usually not necessary to answer every request of the examiners, and some requests are impossible to answer anyway. That concludes this video on Japanese transfer pricing audits. If you have any questions or would like to request more information, please contact either of the individuals on your screen.